FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. The date is February 23rd, 2016. Much to talk about, much to discuss in what's really going on with the economy, not what the markets would like you to believe or the powers that be. And Danielle Park of jugglingdynamite.com with us yet again. And Danielle, hey, interesting times and always great to have you on.
Thank you, Kerry. Always good.
So stop the monetary madness article you wrote several days ago, and kind of fits in with the subprime emerging auto loan crisis or popping of the bubble. I mean, when are they going to learn?
Well, I don't think it's possible for the central banks and the heads of these institutions to admit failure. So I don't think they're going to learn anything. I think it's, as John Malden was so aptly writing yesterday in his piece, The Fed Prepares to Dive, he was pointing out that there is an incredible correlation of habits and behaviors between religion and economics in terms of the people that are very indoctrinated with a particular belief system and being unable to comprehend another option or alternative. And I think that that's precisely what we're seeing with central banks. They all speak from the same textbooks. They all learned the same theories. They all have supreme confidence in their intellect, which I think is the downfall because there's very little common sense. There's a supreme success at book learning, and they've been able to move through a linear education and into, sort of into finance, having studied finance and that sort of thing. But I don't think they have much experience in real life or any perhaps not enough humility to acknowledge the limitations of the theories. And as that Yogi Berra quote that we were just kibitzing about before the show, there's no difference between theory and practice, but in practice there is. And I think that that's the fundamental piece that's missing from all the central bank doctrines.
Yeah, well, the arrogance of them all, that somehow they can repeal all economic laws, they can repeal the business cycle. Hey, maybe you can take steps if you're running your economy wisely to minimize the fallout from business cycles. But as long as we have these credit cycles, we're going to have business cycles, and there's nothing they can do to stop it.
Well, and the fallacy of it, I mean, even Keynes, the piece they always skip in that doctrine, which they espouse so fully, is that he recommended or acknowledged that in order to have a sustainable cycle, you need to pay down debt during boom times. And of course, Kerry, that's the opposite of what most humans do. When cash flow begins to escalate and you're in a pickup or growth phase, that's when people's spending typically ratchets up and even goes farther beyond what their spending growth is, what their income growth is. So because of that, this Keynesian doctrine that's been, swallowed hook, line, and sinker is fatal because there's no controlling for the upside. So they never talk about irrational exuberance anymore when prices are going through the roof, when growth is at a record pace and getting higher and higher and credit is booming. But then they always talk about, people being irrational or unduly gloomy when the mean reversion happens. And that's why it's a completely unrealistic cycle. We cannot have trees that grow to the sky, and we cannot have credit that goes to infinitum in the universe.
Oh, yeah. I mean, when the economy is good, like you said, you should be preparing for bad times. And when the economy is bad, you should be preparing for good times. And we do exactly the opposite. I think it's a human thing. I think it's the way we're wired that probably from when we were out there being hunter-gatherers, when there was a lot of food, got lazy, and when there wasn't much food, then all of a sudden you get very vigilant and preserve everything you can. And then I think it's just a question of the way humans act. When everything is going well, they never think about the downside.
And the ego engages, and they take great credit for growth or, gains. And so that's the problem with debt, right? It's this sort of devil's tool because it makes things expand rapidly as debt is going up. It makes people look like they know what they're doing. It makes the people pulling the little strings appear to be genius. And then when the debt has to mean revert, as is always the case, those same people will scratch their head and say, I don't understand. This wasn't in our models. No one could have seen this coming. This is the rhetoric that they all share, and they espouse it at all their meetings, on all their media, in all their articles. The latest one that you'll hear is that no one foresaw the downturn in oil. No one could have foreseen that. I hear that probably 3 times a day from, both media anchors to, PhD heads of central banks to professors and asset managers. Everybody says that. And that's just garbage. Lots of people that were paying attention to cycles understood that oil should not have got to $100 and plus, and that it wasn't sustainable, and that it was absolutely riding the credit bubble, and that as soon as that credit bubble mean reverted with the end of QE, for example, when it sort of got beyond any reasonable prospect of continuing, then everything has to come back down with it. So it is entirely foreseeable, but it's no fun to, I guess, see the downside, and so it's easier to just say nobody saw it.
Yeah. Well, there were definitely people that saw it. The amount of investment or malinvestment that took place in the oil industry, and I will admit I didn't see the degree there, because I kind of bought into, China's appetite for oil is insatiable, and it takes quite a while to increase oil production in a meaningful way. But then when I look back at the charts, in the 90s, mid 90s, world was consuming 80 million barrels a day, and that was peak oil. Couldn't go any higher. It just couldn't. Well, now fast forward to 2016, we collectively as a world consume 95 million barrels, 93 to 95 million barrels of oil per day. That's almost a 20% increase in production that took place over 2 decades when it wasn't supposed to happen, Danielle. I mean, now granted, with low interest rates, artificially low interest rates, a lot of the investments that were made shouldn't have been, but they were made because of the cost of money. That was the final deciding factor in whether a project should go ahead or not, because interest expense historically is very significant with these low interest rates, kept low for over a decade now. All of a sudden, the whole equation is off. And then what happens, it's just the classic boom, credit-fueled boom that the Austrians talk about, because there's so many people, so many companies drilling wells around the world, the cost of bringing a well into production skyrocket. All right. Inflation, well, it's not really inflation. It's demand-driven inflation takes place. So all of these projects, their break-even point goes from $50 to $70. And then all of a sudden the price hits the skids, and all of these projects that shouldn't have been built, but for low interest rates, get exposed for being economically non-viable.
Well, it's the same exact feature that drove the subprime housing collapse in the United States. It's the same feature that drove the incredible surge in subprime auto loans over the past 6 years. The Canadian auto loan subprime market has grown 20% a year since 2007. That's just the amount of car loans, the growth that has happened. And the reason for that is quite simply because rates were so low, because QE aided and abetted that sort of bad credit, because rates were so low, captive capital looking for yield was recirculating back into asset-backed bonds that were pegged to this auto loan disaster. And so the crappy credit, just as we saw in The Big Short with mortgages, the crappy credit was rolled into things that people were prepared to buy. And then that cash kept the liquidity going, and round it went. And now we have this epic bubble in auto loans, which are now defaulting. Texas and Alberta, not surprisingly, are leading that, Kerry, because that's where all the pickup trucks were going. And we knew for the last couple of years that the pickup trucks were the highest margin vehicles being sold by the North American manufacturers. Their story was all rosy about how much growth and back at record levels and all that good stuff. But if you looked underneath that facade at all, you saw that people were doing insane things with car loans. They were marketing 0 down, 000, don't pay a cent and walk away with a brand new car. Well, people were having a car and then getting enticed back, to get rid of that car. And then there's a balance owing on that loan and they roll that into the next loan. So you have car loans that are more than 100% the value of the vehicle out there. And as people start to lose their jobs in these hot centers, they walk away. Well, of course they walk away if you can't make any payments or the repo guy comes and that sort of thing. So now it's starting to hit the crappy bonds that were compartmentalized off that sector. So, same thing happened with student loans. Same thing, student loans, cheap, funneled through, backed by the government. You get this huge bubble in education facilities and insane pricing that no one can actually afford. They can only manage it if they keep getting more and more debt. And how was that aided and abetted and kept going? Because those same crappy loans were rolled into, more bonds that people have been buying based on that. So it's a model that has plagued us for more than 15 years now. And in the process, we've got gutted financially further and further with each expansion cycle. And now we're staring down the prospects of negative rates, banning cash, whatever other else genius they're coming out with today to try and extend and pretend further. And of course, at some point, it's a completely it's like it defies any kind of intelligence to discuss some of this stuff, and yet they're doing it with a straight face because as I say, their belief is so religious in its zeal and self-protecting against any acknowledgement of mistakes and foolishness that their ego simply will not let them acknowledge how deranged these policies have become.
And the car is a perfect example. Student loans, also look at health. All that money being put in, both to get new doctors through medical school and to pretty much get to pay for expanded healthcare facilities, not necessarily increasing the number of providers there. There was a study done that when for every dollar they upped student loans, it didn't go into educating more people or anything else. The administrators and the professors got higher pay. They did, the last thing the schools did was actually set aside more places for students and educate more people. So that's, that's what happens here.
No, I have in mind for all of this, those balloon-like characters that they have on the top of buildings when they're trying to make you come in for a sale, and they pump the fan underneath, and the long-legged, long-armed blow up, waves in the wind. And to me, that's what a credit bubble's like. As it inflates, it takes these, weak characters and makes them larger than life and, standing strong and tall atop this billowing funnel of credit. And then as soon as that credit interrupts or even retracts or something interrupts the flow, you see them collapse collapse completely right back onto the ground, and then everyone's surprised that happened, which is it's what we've seen. So the CEOs that have got the obscene pay raises have been riding that same billowing surge of free credit that has come from basically aided and abetted by central banks and governments all over the world. This is the Bernanke playbook that he laid out as a Princeton professor, when he was postulating what policymakers ought to have done differently or tried differently in the Great Depression. And then those papers were recommended to Japan, and they started trying to do that after their bubble burst in 89. And so here we are 26 years later. We've really run to the edge of all reason. And yet they're still with a straight face getting out the same songbook and trying another verse.
Yeah. Well, I guess until it's categorically proven that the old ways don't work and they can no longer do it, they're just going to keep pouring gasoline on the fire.
Well, I think the last vestige of any kind of face they have here is this asset values. And so as asset values come down, and let's not forget, despite extraordinary volatility, again, so far this month in February, we've got the Russell 2000 small caps, we've got high yield debt lower, we've got the small caps, we've got the S&P even lower over the month. So we've had, now we're coming to the end of our second month of decline in this new year, and spreads continue to widen between the high yield debt sector and investment grade. And I think these trends are going to continue. You've got every so often some story comes out about, some farcical story, frankly, about the Middle East and them agreeing on some kind of a cut to production of oil in the Middle East. And all of a sudden you see the algos go wild and risk assets rally. But the next day, someone comes out and says, are you kidding me? We're all desperate for cash flow. Nobody can afford to cut anything. We are pumping this thing. It's with both barrels. And, the revelation hits. So I think as the asset prices collapse, as the credit flow has come out and continues to ebb out, and you get that billowing, plastic balloon man flopping over, then you're going to have nothing to recommend these policies by, because the IOUs are some 60 trillion larger in the drawers of all the global world governments, households, companies, everyone are up to the extras in these IOUs, no actual money to support the promises that have been made. And I think that's when, when the system when they can't point to higher asset prices as evidence of success, they'll have nothing to recommend continuing.
Then the emperor will truly be revealed to have no clothes. Danielle, you deal with very well-heeled investors, institutions. Where did all these junk bonds go? The trillions that are out there, who's holding them now?
A lot of institutions, you see. Here's the commonality in this. Sober investors look at things and say, I don't want to put money into things I don't understand or that seem too good to be true. And that's the category of investor that we are at our company and that we work for as individuals. So we didn't buy any of those notes, because if you look at them, we didn't buy any COCOs, this bank type debt that was issued the past few years that can convert to equity when banks are in distress was the rage, right? Because everyone was wanting to look so sophisticated, and they could buy these higher yielding instruments, supposedly beating or being smarter than the low rate options that were available in the investment grade space. But of course, there is no free lunch, and all these complex structures serve most of all the people selling them, who make their commissions up front, and the suckers are left holding it. So you have them in a whole bunch of institutions, you have them in a whole bunch of hedge funds, you have them in a whole bunch of pensions, you have them in a bunch of financial institutions. These things are going to leave gaping holes once more. And once people realize how broad and deep these holes are and how impossible it's going to be to catch them up without increasing contributions by such a magnitude, I think that once that revelation hits again, then people are going to be mad as hell, and they won't know what to do about it, because by then the damage has been done.
Wow. Yeah. Well, the junk bonds, not for the individual ever, unless you're one of those guys who's made his living on them and you can go back and pick the carcasses. You always refer to having cash now because later on the opportunities are just going to be overwhelming for people who are liquid or institutions. So what about a lot of bonds? I'm not just talking about junk bonds, but there's going to be a shakeout in corporate debt, but there's a lot of gems once those prices go down to reasonable levels, because you got much more protection buying a depressed bond than you do buying a depressed stock, right?
Absolutely. So distressed debt by its very name means you should be buying it at a deep discount, right? And that's been the problem with the quote high yield debt market the past few years, is the prices were so outrageous, the yields were so low, there was nothing high yield about it. It was priced as if it was risk free, and it was full of risk. So as prices go higher, that's when risk goes with it. And that's where you don't want to be touching these things. As prices collapse and people are in liquidation mode, that's when you can pick up some fantastic, for pennies on a dollar, and with much higher yields that will compensate you for any capital risk you're taking. So absolutely, the opportunities are coming towards us as we patiently wait with liquidity. There's no question about that. But I think that it's still early days. I think you haven't seen, there's talk today about JP Morgan acknowledging they're having to increase their bad debt reserves for the oil and gas sector bets that they have. But really, nobody knows exactly what the exposure is in these institutions, because they have been very slow to write anything down or to acknowledge losses. That is tenfold in Canada, where that our finance sector is heavily in bed with the energy sector as our primary sort of star turn in this country. And the Canadian banks have minuscule reserves set aside relative to the impending prospects of loss that are mounting. And everyone's been kicking the can saying, oh, well, prices will rebound faster than we'll have to acknowledge any problems here. But that isn't happening.
We hope.
And as that's not happening, as prices aren't rebounding, I think this quarter and next quarter, there's going to be a sober sort of reformulation of all that, what has to be acknowledged at this point. And that's going to hit earnings. That's going to hit earnings for banks. That's going to hit balance sheets. In Europe, they brought in a policy recently where they're saying that institutions have to start valuing their bonds held on their books at market value, which has been basically set aside since March of 2009, Kerry. In all the major countries in the world, they said, let's stop making anyone value these bad bonds. Well, so there's a whole bunch of bad bonds still on the books from last cycle. And now we're getting a whole bunch more from this cycle. And now that, how long can they go without having to acknowledge this sort of stuff under the hood? And I think as it comes, it's going to be a shock to people who aren't expecting it.
Yeah, well, they're getting pretty shocked now, that's for sure. But the opportunity will exist. I mean, a guy in my law school class who's probably a household name in distressed debt may become a multi-billionaire, by far the wealthiest guy that ever went to my law school, just figuring out which of these bonds have value and which don't, and buying them, even if the company's in bankruptcy, done quite well at it. So opportunities will be there, but yes, based on what you're saying, not quite yet.
Not quite yet, but because the one constant about indiscriminate buyers, and there was a ton of them, and a lot of them were the sovereign wealth funds as the commodities producers were exporting and taking in all this extra cash flow the past few years, they were recycling that through financial assets. So they were the dumb money. They were the indiscriminate price takers. And the thing is that as they get the credit crunch, as budget deficits widen at home, as they need cash, the common plight right now is everyone needs cash. And they're all looking to liquidate financial assets in order to plug holes in their spending and deficits. So I think as that continues, those indiscriminate buyers become the indiscriminate sellers. And those are the ones you want to be buying off of, because they're dumping things lock, stock, and barrel at that point. And that's where, if you know what you're looking to buy, but you have to do that work before that happens, you have to do your homework and make your list and have your capital set aside. And that's when you're in the driver's seat.
Yeah, great point. And on that note, to find Danielle's work over at jugglingdynamite.com. We've always got a link to her site in the show notes on financialsurvivalnetwork.com. Danielle, we'll talk to you in a couple of weeks, and I think things are going to rapidly clarify, if you know what I mean.
Awesome. Thanks. Talk to you later.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.